Nvidia is falling, and investors are asking the obvious question, buy the dip, or is this finally a warning sign? Because right now there are two completely different Nvidia stories. On one side, the bulls say investors are becoming too negative. AI spending is still enormous. Nvidia still dominates advanced AI infrastructure. Its latest quarter produced more than $81 billion in revenue. Data center revenue alone reached more than $75 billion, and gross margins remained close to 75%. That does not look like a broken business. But on the other side, Nvidia's biggest customers, the companies fueling this entire AI boom, are quietly building exit doors. Meta is preparing its own AI chip. Google is doubling down on TPUs. Amazon has Trainium. And Microsoft is building its own AI silicon. These companies are not abandoning Nvidia. But AI has become too important for them to depend on one supplier for every workload. And that creates a new question. What happens when Nvidia's biggest customers also become its most serious alternatives? So here's my view. Nvidia's biggest near-term risk is not that AI demand disappears. It's that the market keeps demanding another upside surprise. Quarter after quarter, the company can still grow. Revenue can still rise. AI can still be real. And the stock can still disappoint investors. Because when expectations become this high, good may no longer be good enough. This video is for education only. It is not financial advice. Let's break it down in simple English. First, why is Nvidia under pressure? The easy answer is, chip stocks have been volatile. But that does not explain enough. The real issue is that investors are starting to test the assumptions behind the AI trade. For the last few years, the basic Nvidia story was incredibly powerful. AI models need compute. Compute needs accelerators. Advanced AI accelerators need memory, networking, servers, power, and entire data center systems. Nvidia was sitting near the center of that build-out, so the market rewarded the company, and for good reason. Fiscal 2026 revenue reached nearly $216 billion. That was up 65% from the previous year. Then Nvidia started fiscal 2027 with another record quarter. Again, this is not a weak company. But the market is now asking a different question. How much of the next few years has already been priced into the stock? And what happens if AI spending remains strong, but grows more slowly than investors expect? That is the important distinction. Nvidia does not need to lose customers for the stock to become more volatile. The market only needs to believe that the growth curve is becoming harder to beat. Think about it this way. The first time a company doubles, investors are shocked. The second time, they are impressed. After enough exceptional quarters, exceptional starts to become the expectation. And that is a dangerous place for any stock. Now, before we talk about risk, we need to be fair. Nvidia is not just another chip company, and this is where many bearish arguments become too simple. People often talk about Nvidia as if it only sells GPUs, but Nvidia's advantage is much bigger than one chip. It has CUDA. CUDA is the software platform developers use to build and run accelerated computing workloads on Nvidia hardware. Over time, millions of developers, companies, researchers, and cloud platforms have built around that ecosystem. Then there is networking. AI data centers need chips to communicate with each other at enormous speed. Nvidia has built deeper into that part of the system. Then there are complete platforms, GPUs, CPUs, networking, software, libraries, AI frameworks, and full data center systems. This matters because large customers do not only ask which chip is faster. They also ask how difficult is deployment, how reliable is the software, how quickly can our developers start working, can we scale from thousands of chips to hundreds of thousands, and how much engineering risk are we taking? That is why replacing Nvidia is not as easy as creating a cheaper chip. A custom accelerator can be excellent for one workload. It can be cheaper. It can use less power. It can be optimized for a specific model. But Nvidia's advantage is flexibility. The same ecosystem can support a wide range of AI workloads: training, inference, research, simulation, enterprise AI, and new applications that may not even exist yet. That flexibility has value. This is the bull case. Nvidia is not simply selling silicon. It is selling an AI computing platform. But here's the problem. A strong moat does not remove the expectations problem. Imagine the market expects a company to grow earnings by 45%. Then the company reports 30% growth. 30% is incredible. For most companies, investors would celebrate. But if the stock was already priced for 45%, 30% feels like a miss. The business wins. The stock may still lose. That sounds strange, but this is how expectations work. Stocks do not move only because a company is good or bad. They move because reality is compared with what investors already expected. And Nvidia has trained the market to expect a lot. Strong revenue growth, strong data center demand, new product cycles, high margins, massive hyperscaler spending, and continued leadership in AI infrastructure. The higher the company climbs, the harder it becomes to surprise investors. That is my biggest near-term concern. Not demand disappearing, not Nvidia suddenly becoming irrelevant. The problem is the hurdle. Every strong quarter raises the hurdle for the next one. And eventually, a company can deliver excellent numbers. While the market asks, Is that all? Now we get to the part investors cannot ignore. Nvidia's biggest customers are building alternatives. Meta is preparing to put its Iris AI chip into production. The chip is being developed with Broadcom and manufactured by TSMC. And one goal is clear. Meta wants more control over its AI infrastructure and less dependence on third-party chips. But there is an important detail. Meta is not suddenly throwing Nvidia out of its data centers. In fact, Meta has also committed to major Nvidia infrastructure purchases. The real story is more complicated. Big tech is becoming more strategic. A company may use Nvidia GPUs for the most advanced training workloads, then use custom silicon for specific inference tasks, or internal services, or workloads where cost matters more than flexibility. Google has been developing TPUs for years. Amazon has Trainium. Microsoft has its own AI chip efforts. Meta has its custom chip roadmap. And Broadcom is helping major technology companies develop specialized AI hardware. So the real risk is not everyone stops buying Nvidia. That is too simplistic. The real question is, does Nvidia continue capturing the same share of every new dollar of AI infrastructure spending? Because a hyperscaler may still spend more on AI, while directing a larger part of that budget toward internal chips. This is the subtle risk. More AI spending does not automatically mean every new dollar goes to Nvidia. Nvidia's customers are not disappearing. They are becoming more strategic about where they use Nvidia GPUs and where they do not. The next risk is AI capital spending. This is where Nvidia's story connects to the entire technology market. Big tech is spending enormous amounts of money on AI infrastructure. Data centers, chips, networking, power, cooling, land, construction. The numbers are huge, and Nvidia benefits when that infrastructure expands. But here's the mistake investors often make. They ask, will big tech keep spending on AI? I think that is the wrong question. The better question is, how fast will that spending grow? Because the risk isn't zero AI spending. It's slower than expected spending. Imagine a major cloud company increases AI investment by 50%. The market gets excited. Then next year, the same company increases spending by 20%. It is still spending more. AI is still growing. The company is still building data centers. But the growth rate slowed. For a supplier priced around extremely fast infrastructure growth, that slowdown matters. And now investors are asking another question. Return on investment. How much revenue is AI generating? How much productivity is it creating? How many customers are paying? And how long before these enormous data center investments produce acceptable returns? If big tech sees strong returns, spending can remain aggressive. But if the payback period becomes longer, or AI pricing becomes more competitive, or excess capacity appears, capital spending growth can change quickly. Again, the risk isn't AI disappearing. It's the growth rate of AI spending disappointing the market. Now let's talk about margins. Nvidia's margins are one of the reasons investors love the company. In its latest reported quarter, GAAP gross margin was 74.9%. That is extremely strong. And bulls believe Nvidia has enough pricing power to protect those margins. Some bullish analysts argue that investors may be too worried about rising high-bandwidth memory costs and custom chip competition. The bullish argument is that Nvidia sells increasing system-level value, not just a faster GPU, a more powerful platform, a bigger system, more networking, more software, and newer generations of AI infrastructure that can support pricing. But here's the real test. Pricing power only matters if customers keep accepting the price. This is where custom chips matter again. If customers believe Nvidia offers the best total value, they will keep paying. If a specific workload can run much more cheaply on internal silicon, a hyperscaler has an incentive to move that workload. And here's the part that many investors may miss. Nvidia is no longer just selling individual chips. It is increasingly selling full AI data center systems. That means GPUs, networking, memory, interconnects, rack-scale integration, and much more supply chain complexity. This is powerful for revenue, but it can also change the margin story. In its own filing, Nvidia said gross margin fell from 75.0% in fiscal 2025 to 71.1% in fiscal 2026. Part of that decline came as the business shifted from Hopper HGX systems toward Blackwell full-scale data center solutions. There was also a major H20-related inventory and purchase obligation charge. Nvidia recorded a $4.5 billion charge connected to H20 excess inventory and purchase obligations. So the point is not that Nvidia suddenly has weak margins. It does not. The point is that as Nvidia sells bigger and more complex AI systems, investors need to watch whether revenue growth and margin quality move together. Because higher revenue does not automatically mean higher margins. Revenue tells us how strong demand is. Margins tell us the quality of that growth. And that is why I watch both. So, is Nvidia's decline an opportunity or a warning sign? Here is the MarketMind AI 5-question framework. Pause here. 3, 2, 1. Screenshot this. Question 1. Demand. Is AI demand still accelerating, not just growing? Accelerating. Watch data center revenue, hyperscaler spending, cloud demand, and AI infrastructure orders. Question 2. Pricing power. Can Nvidia keep increasing the value of each new platform? Watch the relationship between product performance, system value, and customer willingness to pay. Question 3. Alternatives. Are hyperscalers moving more workloads to custom chips? Do not ask whether Nvidia disappears. Ask which workloads customers decide Nvidia is essential for and which workloads they move elsewhere. Question 4. Margins. Are gross margins holding up? Watch memory costs, system complexity, product transitions, H20-related effects, and competition. Question 5. Expectations. Is the stock priced for another upside surprise? This is the most important question, because Nvidia can beat last year's numbers and still disappoint this year's expectations. A great company can continue winning, but if the market already expects dominance, the company has to keep proving that dominance is worth even more. So here's my conclusion. I do not think Nvidia's main problem is collapsing AI demand. The latest business numbers do not support that argument. Data center revenue remains enormous. AI infrastructure spending is still a major technology trend, and Nvidia still has one of the strongest platforms in the industry. But the bigger risk is the expectations gap. Nvidia may still be the strongest company in the AI chip trade, but the stronger the company becomes, the harder it gets to surprise a market that already expects dominance. At the same time, Nvidia's biggest customers are building alternatives, not because AI is failing, because AI is becoming too important for those companies to depend on only one strategy. That changes the Nvidia story. The question is no longer, will AI need chips? Of course it will. The question is, how much of the next dollar of AI spending goes to Nvidia? At what price? At what margin? And how much growth has the market already assumed? That is why this decline is not automatically an opportunity, and it is not automatically a warning. The answer depends on one thing. Can Nvidia keep beating the future investors have already paid for? That is the number I would watch, not the hype, not one red trading day, the expectations gap. Next week, I'll use the same framework to analyze another semiconductor stock, AMD, Broadcom, Micron, or ASML. Comment the ticker below. I'll take the stock with the most requests and go deeper. Demand, pricing power, competition, margins, and expectations. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.